This is Nightly Business Report with Tyler Matheson and Susie Gehring.
The bulls are back, for one day at least. Citigroup surprises the street with better than expected earnings, putting investors in a buying mood. So will the optimism continue when results from some of the world's biggest companies hit the street all the rest of this week?
Super salaries. Which CEOs are bringing home the biggest paychecks? We have the names and the numbers.
Managing your nest egg, TIAA-CREF, already a retirement giant, wants to get even bigger. But will its deal to buy Nuveen pay off as a way to woo more savers? All that and more tonight on Nightly Business Report for Monday, April 14th.
Good evening, everyone. A beautiful spring day on Wall Street today and lots of green in the stock market to go with it. The major averages bounced back from sharp sell-offs last week, and all 10 of the S&P sectors were up as well. Here's a look at the closing numbers. The Dow jumped 146 points. The Nasdaq added almost 23, ending above the key 4,000 level, and the S&P rose about 15 points. So what triggered all this optimism? Investors were encouraged by new retail sales numbers that were stronger than expected, a sign maybe that the economy is emerging from a slow winter. The gains were led by autos and furniture, as well as sales at general merchandise stores like Target and Walmart. Also, solid earnings from Citigroup boosted investor confidence. Profits for the first quarter came in higher than analyst estimates, and Citi stock surged 4% on the news. Kayla Tausche joins us now with more on that surprising report from Citi. You know, Kayla, last week we were talking to you about this, and everyone was bracing for a lousy report. And then this. I mean, what happened?
This isn't much to write home about, Susie. We should make that clear. The 2 points where Citi surprised. Number one, the biggest jump in revenues came from its bad bank, created 5 years ago. That's Citi Holdings. So that has been a drag on the company. But now the value of that portfolio is rising, and that was actually the biggest source of growth. Number two, credit is getting better. So Citi was able to release more money from what it had been stowing away to cover loans that would go bad. They released about $673 million there. The street wasn't expecting that.
Let's talk a little bit about the international sweep of Citi. It is the U.S. bank with the biggest international footprint. Do these results say anything about the overall health of the global economy?
Well, as expected, we saw a lot of growth on the Asian consumer side and the Latin American consumer side. That was really the runaway growth on the consumer sector. What we didn't see is a whole lot of corporate activity across the board. A lot of people expected that with rates staying low in the first quarter and the stock market going up, that there would be a lot more M&A activity, a lot more refinancing that continued. But we didn't really see that happening, and there also wasn't a whole lot of trading either. One surprise, though, actually may not surprise you, but Citi Holdings, which I just mentioned, it is the majority of that is the U.S. housing market. It's subprime mortgages, it's old line mortgage portfolios. The value of that rose very sharply, and a lot of the executives were just talking about how the U.S. housing market recovery is one of the main stories for their business.
So you're telling us a lot of stuff that's going the way of Citi. Can investors expect Citi to give a dividend anytime soon? It's been a while since they've seen one of those. Do you think the Federal Reserve will give the okay on that?
So they have a 1 cent dividend. They wanted to raise it to 5 cents, but unfortunately they did not pass the capital return portion of the Fed stress test. Executives today on the conference call said that they would not be resubmitting that plan to the Fed. Instead, they're going to hunker down and try and rebuild those processes, make them more robust, resubmit next year. So investors are going to have to wait at least 3 more quarters for that.
Kayla, thanks very much. Kayla Tausche reporting tonight. Well, Citi is just the start of a big week for corporate earnings. More banks are due to report, along with a handful of blue chips, among them Coca-Cola, General Electric, Intel, Johnson & Johnson, and Yahoo. Dominic Chu now with a look ahead at what to expect and whether the results could further lift the market.
This is a huge week for bank earnings. In addition to Citigroup, later on this week, all of the other major banks will report. On Wednesday, Bank of America is out before the opening bell. Goldman Sachs and Morgan Stanley both report before Thursday's start of trading. Bank and other financial stocks are important for the market because the sector is the second biggest in the S&P 500 right after technology. They've also underperformed as a group for such a long time. Even today, with stocks near record highs, bank stocks are still a long way off from recouping losses from the financial crisis. But some see opportunity.
We do like the financials. We own some of the big names. It was nice to see Wells Fargo put up a good number last week. We like the smaller banks as well, because they're the ones that don't have as much capital markets activity that'll benefit from increasing loan demand. We're seeing good loan growth in some of the mid and small sized banks.
Banks aren't the only game in town this week, though. During this holiday shortened trading week, 9 Dow components will deliver earnings results, as well as over 50 S&P 500 companies, including Coca-Cola and Intel tomorrow, Google and IBM on Wednesday, and GE and Union Pacific on Thursday. Traders are struggling to find conviction to either buy or sell this market, and earnings will be a big part of the decision.
But at the end of the day, earnings are what counts. This is a market of stocks. This isn't a stock market, so we need to focus on exactly what the company's numbers are, but even more importantly, what's their guidance looking forward and how are they seeing the economy in the months ahead? Concerns are growing about whether or not we're at a market peak. And earnings reports are seen as a major catalyst for either helping to set new record highs for stocks or giving traders a reason to sell and lock in profits. For Nightly Business Report, I'm Dominic Chu.
Even though stocks rallied today, there's still a pretty lively debate between the bulls and the bears on Wall Street. And tonight, we're going to hear from both sides. Michael Farr, president of Farr Miller in Washington, is bullish, and our bear is Barry James, president of James Advantage Funds. Gentlemen, welcome to you both. Let me begin with Barry. Tell us, make a case for why you're not so bullish. Why are you pessimistic on the markets right now?
Well, it's just a matter of risk. Again, no one really knows whether the market will go up or down, but our risk measurements are saying that there's high risk. And some of the reasons behind that, from a macro standpoint, the Federal Reserve is tapering. And in the past, 2 times when they've quit quantitative easing, the market fell at a 20% annualized pace. The other thing we see is that valuation levels are not where you would associate them at the beginning of a new bull market. Back in 2009, we were closer to 1 times book value. We're much higher than that. And the average PE on the S&P 500 is 25. But probably the most telling thing for the next few months has been sentiment readings. We haven't seen bullishness like we've seen in the past few months until 2007. And bearish levels were not this low going all the way back to 2000. We also find Wall Street is very excited. There are about 50% more buy recommendations to sell recommendations on Wall Street today than normal. We see insiders are selling. And one thing that really gives us the chills is the fact that margin debt, borrowing money to buy stocks, is at all-time highs. So all of those kind of say that we're in a high-risk period right now, and we should probably take a little bit off the table to try to preserve some capital should a correction come.
All right, Michael, Barry has laid out a very full case here. How do you react to it? I know you to be an extremely cautious guy, especially when you're playing with other people's money, which is what you do.
No question about it, Tyler. And Barry makes a good case. I want to pick on a little bit of some of his data points. But in general, I don't think you can time the market. I don't think you can pick market tops. Alan Greenspan talked about irrational exuberance in 1996 when the Dow was 6,000. It was 8,000 8 months later. It was 11,500 4 years later. So it's very difficult to weave your way through this. Now, when Barry talked about the market being 25 times earnings, he was looking at that Shiller PE. The market's actually about 16 and a half times earnings right now. If you go back to average earnings and take a look at Shiller numbers, yes, it looks higher. And yes, that worries me from a margin point of view. But I think that there are still companies that you find that have good, strong balance sheets, growing earnings on the top line and the bottom line. You don't have to pay too much for them. I think you own them to weather storms like this. And I think you stay invested. The economy is recovering. It's a slow recovery, but it is coming out of this, and we're maybe picking up some traction. I'm certainly not a seller.
Okay. All right. So I want to pick up on that, Michael, because a lot of people at home who are watching this, they've seen over the last couple of days these really sharp sell-offs. And yes, some of them are biotechs and some of them are the high flyers, but they're taking down a lot of the regular stock companies as well. So are you saying put your money in anyway and don't worry about, you know, all of this selling?
My friend Freddie Towers says the time to invest is when you have money. The time to sell is when you need money. Otherwise, don't think about the stock market. I think opportunistically, when folks are being fearful and you see this huge swath of selling, that's when you get your list out and see if perhaps there's some value being created and you want to buy. The stock market could certainly have a 10% correction or a 15% correction. We haven't had one in a long time. But trying to figure out when it's going to be, to me, doesn't make sense. And I want to stay invested through the whole period. If you'd sold out in 2008 or 9, you'd be in trouble now. If you stayed through, you have a lot more money, even after going through that.
To be clear, Barry, I think you think that there's the likelihood of a correction coming, but you think the market may well be higher by the end of the year than it is today. And second, you're not saying sell everything. In fact, if I read you right, you're saying buy selectively, particularly in energy. We've got about 30 seconds if you could sum it up.
That's exactly right. As we look at today, when over 42 years in this business, we know that we don't have the high or the low, but we slice our way out of the market. We've been 55 to 60%. Now we're 40 to 45% in stocks. There are pockets, exactly as Michael described, of very good companies, and we can get them at a little bit of a discount. It's a good time to go ahead and move forward. But we would say that there are higher risk, and actually bonds today, as they've been so far this year, still look like a better play for stocks, say, over the next quarter.
All right, interesting place to leave this conversation. I hope we can continue it at some point. Gentlemen, thank you so much. Michael Farr of Farr Miller in Washington and Barry James of James Advantage Funds.
U.S. budget deficit continues to shrink. It is expected to fall to around $500 billion this year. That is less than 3% of the nation's gross domestic product. Congressional Budget Office says that the deficit will be the lowest in 6 years and down more than 60% from the record $1.5 trillion during the peak of the financial crisis. Today's projections are lower than earlier forecasts. One reason, lower estimates of the subsidy costs under the Affordable Care Act.
Americans are also feeling more optimistic about the job market. According to a March survey by the Federal Reserve Bank of New York, they felt they had a 49% chance for finding a new job should they lose their current one. That was up from 46% back in February. Now, workers under 40 were the most optimistic. They put their chance of finding work at more than 60%.
Strong gains in the stock market contributing to a hefty jump in pay for the chief executive officers of the country's 100 largest companies in 2013. Mary Thompson now takes a look at which CEOs topped the list and the salaries and perks that got them there.
Those at the top of the corporate ladder continue to take down more in pay.
The stock market was up 26.5% last year, so that's going to be a big factor in all of this.
With over half of a CEO's compensation tied to their company's stock performance, it figures as the market goes up, so too do their paychecks, as they did in 2013. An Equilar survey shows CEOs at the nation's 100 largest companies by revenue pulled down almost $14 million in median pay last year, a 9% increase from 2012. Average pay remained unchanged at just over $14.5 million. Topping the list as he did last year, Oracle CEO Larry Ellison. The founder of the software giant awarded $77 million of his $78 million in pay in an option grant. Oracle's board continues to ignore shareholders who voted no on Ellison's pay for 2 years in a row.
A say on pay is an advisory vote. Directors don't have to act on it, they just have to consider it. Still, Professor Jay Brown, who focuses on executive compensation, says by ignoring shareholders' wishes now, Oracle's board could be causing problems for other boards in the future.
What this does is it says to the public, not just shareholders, but to the public, that advisory votes can be ignored. And what that can often do, as it has done, for example, in Europe and the UK, is it can result in pressure being put on politicians to make say-on-pay votes more meaningful.
And that could mean restrictions on what's paid to the C-suite. But for now, it's the board that decides. And last year, Disney's board made CEO Bob Iger the second highest paid CEO among big companies. He pulled down just over $34 million, a 7% decline from 2012, even as the media giant's total return rose 29%. Rounding out the top three, a perennial on the highest paid list, 21st Century Fox's Rupert Murdoch. He earned just over $26 million, proving even when you're on top, your pay at least can climb some more. For Nightly Business Report, I'm Mary Thompson.
Still ahead, details on the multi-billion-dollar deal that's lifting retirement giant TIAA Kraft into the top ranks of the U.S. mutual fund business. That story next.
A marriage of two money managers today. TIAA-CREF is buying Nuveen Investments. It's a deal valued at more than $6 billion. And the merger is partly the result of the changing way people are saving for retirement and the increasing competition to manage your nest egg. Bertha Coombs has more.
TIAA-CREF is already the nation's leader in retirement funds for academic, research, and nonprofit institutions with nearly 5 million customers. Analysts say adding Nuveen Investments could help it expand its mutual fund business.
As the retirement industry moves away from pensions and into defined contribution or those 401k plans, having a big presence there can be really important to TIAA-CREF.
Nuveen is the nation's largest manager of closed-end funds, which appeal to long-term investors. Fitch analysts say the acquisition, valued at nearly $6.3 billion, will provide TIAA-CREF with a new revenue stream to pay its pension clients.
Instead of having corporate bonds or U.S. Treasuries or commercial mortgage loans as an investment, some of the money will be in an investment called Nuveen Investments, which will ultimately pay dividends to the parent. So it's another sort of earning assets for TIAA policyholders.
Just as important, TIAA-CREF says the deal will allow it to provide its clients with a wider range of investment choices in tax-exempt bond funds, commodities, and real estate options.
I think it's a comment on how scale can be helpful in the retirement business and having your fingers in a lot of pies. We see a lot of complicated products and investments in retirement plans, and this gives the firm a few more options to deal with.
The acquisition, if approved, would make TIAA-CREF a much bigger player in the mutual fund market, bringing it to more than $800 billion under management. But it would still lag well behind fund giants like Vanguard Group, with nearly $3 trillion under management, and BlackRock, which reported more than $4 trillion last year. Bertha Coombs, Nightly Business Report.
Google says it has agreed to buy Titan Aerospace, the drone maker that Facebook was once in buyout talks with, and that is where we begin tonight's market focus. The internet search giant wants to use the high-altitude solar-powered drones to collect images and get more of the world's population online. No word on how much Google paid for Titan. Facebook did end up purchasing its own drone company, so there. It's called Ascenta. Shares of Google Class A rose nearly 1.5% today to $545.20. More on Facebook now. It is apparently no longer content with being just the largest social media website in the world. It's reportedly preparing to provide online financial services starting in Ireland. According to these reports, Facebook just needs the approval of the Irish Regulatory Board to offer users several types of financial transactions online. Shares of Facebook up slightly today at $58.89. WebMD says it expects to report strong first quarter results at the end of the month. It anticipates reaching the upper end of its annual earnings and revenue projections. The health information provider says 32% more people used its website in the first 3 months of the year, and that gave a big boost to its ad sales. Shares surged 16.5% today to $43.87. And General Motors gained ground today after saying it is replacing the executives in charge of communications and human resources. The company insists the changes are not linked to its ongoing safety crisis over faulty ignition switches. Instead, GM attributes the moves to CEO Mary Barra, who took over in February, making her own hires in key positions as she builds her own team. Let's take a look at shares of General Motors, up 62 cents at $32.55.
Medical device maker Edwards Lifesciences was the best performer in the S&P 500 today. It got a favorable court ruling on a key patent. A federal judge has reaffirmed an earlier ruling that Medtronic's core value system infringes on Edwards' patent for a replacement heart valve. Shares of Edwards Lifesciences surged 11% to $81. Medtronic, meanwhile, fell about 2% to $58 and change. Shares of Goodrich Petroleum surged today on news that it's drilled its second successful well in the Tuscaloosa Marine Shale. That bolstered confidence in the field and the production potential of that area, which spans parts of Louisiana and Mississippi. The stock rose more than 30% to $23.96. And Twitter moved higher after its co-founders Jack Dorsey and Evan Williams, along with CEO Richard Costello, have all said that they have no plans to sell any of their company shares. Now, the reason is that Twitter debuted at $26, jumped to more than $74 in less than 2 months, but has since pulled back sharply. Shares closed today at $40.87, a gain of 2%.
The harsh winter weather took a toll on the nation's farmland, and this evening, in a new government report, we get a first look at the damage that was done and how much of an impact it may have on the spring planting season. Jackie DeAngelis has the details and what it may mean for the price of food.
By all accounts, it was a brutal winter, and even though the weather may be looking up, that doesn't mean that the damage hasn't been done. For farmers, that is. Last week, the USDA revised and tightened its crop estimates for last year, and today it said that the 2014 planting pace for corn was 3%. That's in line with analyst expectations, but below the 6% five-year average. What does the crop report mean for your wallet? Well, it could mean higher prices this summer at the market, and it wouldn't just be for fresh corn. It would also be for packaged foods that use corn as an ingredient. And harsh winter weather didn't just impact corn's planting pace, but it also hurt other dormant plants. Broken limbs and torn vines. Some are beyond repair. In some cases, the extended winter chill delayed budding altogether. In other cases, buds popped, then froze. Recent damage has been reported to peach and cherry trees. Some growers fear that their entire lot may be gone. And the dry, cold weather has endangered California's $2 billion citrus industry. Early projections suggesting that 40% of California's orange crop and 20% of its lemons could be lost, amounting to more than $400 million in lost revenue. Add it all up, and fruit prices may jump 2.5% to 3% this year. To add insult to injury, beef prices are at their highest level since 1987, just in time for grilling season. That's because less corn meant less feed for cattle, which translated to less supply. Couple that with an increase in export demand, and beef prices rose 25 cents from January to February. Industry analysts say there could be more hikes to come. What does it all mean? Hold on to your wallet this summer. For Nightly Business Report, I'm Jackie DeAngelis.
And coming up, meet the company that's trying to develop the next big thing in technology that may one day make your smartphones and tablets obsolete. That's next.
The future may be a lot closer than you think. Imagine not needing your smartphone or tablet and instead getting all the information you need from a pair of glasses. One Silicon Valley startup is trying to do just that and sees endless possibilities for both consumers and businesses. Josh Lipton has more.
Up in the hills above Silicon Valley, 30 engineers live and work together in a modern-day commune where the goal is to create a revolutionary product.
Here we're looking at a model of a house and separating the various layers of it.
Welcome to Meta, a leader in the growing field of augmented reality. Put on Meta's glasses and your reality is enhanced with holograms that you feel like you can touch and move with your hands. When I tried it, I saw a 3D image of a building that I could examine and move around the room. Analysts at Gartner say Meta could appeal to professionals who want to work in 3D environments with their hands. Architects could show holograms of their buildings to clients. Interior designers could show customers what a couch would look like in their living rooms. And Meta says it's already been in touch with Boeing about potential applications. There are also big possibilities in the field of visual entertainment.
Most of all, I think entertainment and gaming stand to benefit from this. People just want to see a 300-inch TV screen that's 3D, and they want to see the Jurassic Park dinosaur's head swinging across their living room, and when they freeze frame, they could walk around that head because we're tracking the world.
Meta has already raised close to $10 million in its first year. Its high-profile investors include Dolby Digital, Y Combinator, and Tony Hsieh of Zappos. Meta's glasses will be available through its website this fall for $3,000, and the company's CEO sees disruptive potential in the technology.
Then you could begin imagining a world where you don't have to carry around these flat devices and remember if they're charged, and remember, if you brought them in your briefcase to work today. But you just have a pair of kind of glasses that encompass everything.
It may be a long time before Meta is the must-have product that replaces our smartphones and tablets. The technology is still in its infancy. Meta is often compared to Google Glass, which goes on sale tomorrow for one day only to the public. Google's wearable lets users search the web, use apps, and respond to voice commands. But with Meta, you can see objects in 3 dimensions, while Google is 2D. Gribbett says he isn't interested in selling his company, but instead wants to turn it into a transformative powerhouse. We'll see this fall whether consumers and companies are as excited as he is about Meta's high-tech and high-priced glasses. Josh Lipton, Nightly Business Report, Silicon Valley.
And finally, we leave you with this, some good news as many Americans are racing to meet tomorrow's tax deadline. Your chances of being audited are lower than they've been in years. Steep budget cuts mean the Internal Revenue Service has fewer agents auditing returns than at any time since at least the 1980s. If you look at last year's numbers, the IRS audited less than 1% of all returns from individuals. And according to the IRS commissioner, this year the numbers will be even lower. You're feeling better, Tyler?
I guess that's a small comfort. That's nice.
Did you get
Nice
your
to know.
taxes in?
I did.
Okay,
I finished.
Good. He did it. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for watching.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we'll hope to see you right back here tomorrow night.
I'm Susie Garrett with a Nightly Business Report news brief. Green was the color of the day on Wall Street as stocks rallied, bouncing back from last week's sell-offs. The Dow jumped 146 points. The Nasdaq added almost 23, ending above the key 4,000 level. And the S&P rose about 15 points. Better than expected earnings from Citigroup and strong retail sales in March boosted investor confidence. Americans are also feeling more upbeat about the job market, according to a new Federal Reserve survey. They feel they have a 49% chance for finding a new job should they lose their current one. And a day ahead of the deadline to file taxes, the IRS says your chances of being audited are lower than they've been in years, well below 1%. Be sure to tune into Nightly Business Report right here on your public television station.